when we are looking at investments, we evaluate them from the lens of six criteria. So one is appreciation, pretty easy. How much does my investment increase in value? Two is cash flow. How much is this investment paying me on a regular basis, whether it's monthly or quarterly? Three is tax benefits. What kind of tax benefits is this investment giving me? Four is risk, right? How risky of an investment is this? Five is liquidity. How easy is it for me if I want to sell and get my money back? How easy is it to do that? And then six is a charitable or impact investing, right? Altruistic investing.
Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flows, and tax benefits. Together with investors, we're investing in over 1,000 multifamily apartments under renovation and over 500 single-family homes under development. And we're expanding into private debt, industrial commercial real estate, oil and gas ventures, and much more to create a diversified, balanced portfolio, which we're going to talk about today. Before we begin, our typical disclaimer, we are not financial advisors. All investments are subject to risks and including the possible loss of the money you invest. So please perform your due diligence and consult your CPA, your financial advisor, and your lawyer before making any investments. Again, I'm your host, John Lai. I'm joined by my partner and my friend, Keshav Kolur from Clive Capital. And today's episode, we're going to talk about building a balanced portfolio of private equity investments for any stage of your life. Now, we're not just going to limit it to private equity. We're going to also talk about the public equities or public markets as well. Again, today is my guest and friend, Keshav. Keshav, welcome back. It's been a little bit of time. It's a delight to always have you back. We have an exciting episode today where we can help our investors and prospective investors learn a little bit more about private equity, as well as learn about the public markets and how they can develop a balanced portfolio of passive income. For those who don't know your journey and how we founded Clive Capital, do you want to talk a little bit about how you got to where you are today?
Thanks for having me on today, John. And it's been great having you take over the podcast. Love the energy and enthusiasm and the knowledge, the experience that you're bringing to the podcast. So my background, I come from a tech background, graduated college as a mechanical engineer, went into work as a software engineer at a car company, working on autonomous driving algorithms, specifically cruise control. And this is in Detroit, Michigan. And that I spent about 2 years there, then switched to Amazon in 2021, March of 2021. That's where you and I met. And then in November of 2021, switched to Meta and also moved to New York City then. On the investing side of things, well, in addition to that, we run the investment clubs, right? You run the investment club at Amazon that we started together. And then once I joined Meta, I opened up the investment club there as well. On the investment side of things, out of college, I read Rich Dad, Poor Dad, just because I knew I didn't, want to work for someone else for the rest of my life. And that got me thinking about real estate, not necessarily syndications, and maybe it should have, but it would have saved me some pain, but better late than never. Got me thinking about real estate, but at the time I didn't have any experience or capital, and I thought the best way to go about getting more of both of those was to become a realtor. So I got my realtor's license, and on Leap Day, actually, February 29th, 2020, so almost 5 years ago now. Wow, time has flown. And then we all remember what happened, right? In 2020, a few weeks later, COVID shut the markets down. Later that year, though, once I had helped people sell and buy a few homes, saved up some capital from my W-2 and from being a realtor, started looking at single-family rentals to buy. Luckily, before I went too far down that rabbit hole, one of my very good friends came across a Reddit thread where a guy was talking about investing into entire apartment buildings, not just single family homes, because this person from Reddit had invested into over 40 single family homes at their peak. And he said that investing into apartment building was way easier, more profitable, more tax efficient. And personally, to me, it sounds cooler to invest into an entire building than just one home at a time. So I thought this is really cool, but this sounds too good to be true. None of my friends or family has been doing this. So I actually took a year to network with people in the industry and get really familiar with this space. And uh, let's see, analyzed deals, right? Watched YouTube tutorials, read books, all that stuff, got educated. 1 year later, August or September of 2021, finally felt comfortable, made my first investment as an LP into an apartment building in San Antonio, and started seeing the cash flow coming in, the passive income that we're all after. And once that started working, that was a proof of concept to me that, hey, this stuff works. I'm going to do this for myself, and I might as well do it for my friends and family and anyone else who's interested. So I started Clive Capital January of 2022, and our goal is to help primarily tech professionals invest into passive private equity opportunities to build generational wealth, passive income, reduce their tax bill, achieve financial freedom, all the good stuff. And so far, as you mentioned, we've helped our investors primarily from tech companies like Amazon and Meta, where you and I worked, and Google, Microsoft, etc., invest into all the assets that you mentioned and many more to come.
That's fantastic. Thank you for that background. Um, let's set the stage first. For people who are unfamiliar with private equity investments, as W-2 employees, you're primarily familiar with 401ks, IRAs, and investing in maybe the public stock market, maybe bonds, but private equity, you just hear about private equity in like the trader market or large Wall Street private equity firms, hedge funds. From our perspective, we like individual investors to also consider private equity. Do we want to describe them a bit, and why are we even talking about them?
Yeah, I'd say private equity opportunities are basically any opportunities that aren't publicly traded, right? Publicly traded meaning you can go sign up on Robinhood or Fidelity or Vanguard and just buy and sell shares easily. Private equity is, these are typically not, how do I say this? They're typically not on these platforms. They're typically not on Vanguard. They're not on Fidelity. They're not on Robinhood. These are private opportunities that uh, you you have to usually hear about it from someone else to invest into. And the few reasons for that, one, the investment minimum, you typically is $50,000. And there's not a lot of people out there, unfortunately, who have $50,000 sitting around to just invest into one opportunity. So that's one. These opportunities cater to people who have large amounts of capital saved up and can also continue to deploy that level of capital year after year, right? Not just one $50,000 investment. How many people do you know who can afford $50,000 investments year after year? And secondly, it's just from a regulatory perspective, it's until 2012, the Jobs Act, you could not publicly discuss these private equity opportunities. It had to be through word of mouth. What the Jobs Act did, part of it, was allow for people to raise capital for these private equity opportunities by publicly advertising. So once you start public advertising, then word gets out a lot easier and more often. But still, it's not completely that's well understood. And unfortunately, most people just think that they are completely just restricted to the stock market. But with private equity, typically you have to sign legal documents that attorneys prepare. They are securities at the end of the day. So, they are monitored by the SEC. And you typically sign documents like PPMs, private placement memorandums, maybe operating agreements, OA, subscription agreements, SA, things like that. You will see a pitch deck about what the investment is. You'll see some underwriting and financial modeling that goes through the projections. And that's at a high level how private equity works. And when you think of private equity, it could be a real estate building. well, not just apartment building, it could be office building, it could be a senior living facility or building, it could be self-storage buildings. It can also be, it can be businesses that you buy. It can be energy. You can invest into oil and gas like we're doing. You can invest into solar. And then someone we know is actually putting together private equity deals to buy US soccer teams. So just about anything, as long as it's not publicly traded and available to everyone at the click of a button, just like, Fidelity is, I would say that's private equity, more or less.
Yeah, and I heard that if you look at high net worth, ultra high net worth individuals, sure they have public equities and bonds. They have their personal real estate, maybe even additional homes like vacation homes, but private equity and commercial real estate make up a disproportionate share of their portfolio, right? Their net worth. So that's interesting. If you're ever thinking about becoming one of those high net worth individuals, definitely consider private equity in your portfolio. You mentioned multifamily syndications. Obviously, there's built to rent, triple net commercial leases, and the like. Why do we think that commercial real estate, I'm going to classify them as commercial real estate, but also more broadly, private equity is a superior asset class or asset classes to residential real estate?
Yeah, so when we are looking at investments, we evaluate them from the lens of six criteria. So one is appreciation, pretty easy. How much does my investment increase in value? Two is cash flow. How much is this investment paying me on a regular basis, whether it's monthly or quarterly? Three is tax benefits. What kind of tax benefits is this investment giving me? Four is risk, right? How risky of an investment is this? Five is liquidity. How easy is it for me if I want to sell and get my money back? How easy is it to do that? And then six is a charitable or impact investing, right? Altruistic investing. Those are the criteria that we look at investments from. So the stock market, if we were to evaluate it at using the six criteria, the stock market appreciates at 10% a year, right? Typically that's your average growth. So that's one. Number one. Two, for cash flow in the stock market, that's the equivalent of dividends. Usually you're going to get 3 to 4% in dividends in the stock market, as far as I've seen,
Yeah.
right? And if you do get really high dividends, that's usually comes at the loss of appreciation. You really have to pick one or the other. Third, tax benefits. The stock market, it has capital gains tax and, qualified business income, I believe, or dividends, where dividends get taxed as capital gains. Beyond that, not much. Risk, and I'll say risk slash volatility. We've seen how volatile the stock market can be. A few weeks ago, when
Right.
the market was freaking out over DeepSeek, I think Nvidia lost hundreds of billions of dollars in a matter
Yeah.
of a couple of days. And more broadly, close to $1 trillion at some point was wiped out from the stock market, US stock market. So things like that at the push of a button, investors, algorithms can panic buy, panic sell. I mean, we saw what happened with GameStop too, right? A few years ago, where there were no fundamentals and it was just pushed up on a fear of, on FOMO and emotions. In my opinion, in that regard, it's a step above, at best, one step above a casino. Beyond that, liquidity, that is one thing I'll give the stock market. It's pretty easy to buy and sell. And that's, people might consider that a pro. I consider that a con, honestly, because that promotes that monkey behavior of buying when everyone else is buying, which is usually when the price is high, and then selling when everyone else is selling, or when you feel like you should be selling, which is when the price is low, right? Panic buy, panic
Right.
sell. And lastly, charitable. I don't know where the stock market ranks on that. Now, private equity, on the other hand, again, going through the six criteria, we typically conservatively target a 15 to 30% return on our investments. You might think that's crazy to those of you listening at home, but every investment that we put out, we share with you what the financial modeling is of the investment that we're making. Also, especially, at least this is the case in real estate, the biggest investor in a deal is never you. It's almost always the bank. And maybe in 2008, banks were really lenient and you could have questioned their underwriting practices, but since then, they've really cleaned up. So 60 to 70% of our capital that we raise from quote unquote investors is from the bank. So if a bank is willing to back 60 to 70% of it, then you should feel fairly comfortable that, hey, this is a somewhat legitimate investment. Not saying that's the only check you should be performing, but I'm just saying that it's not completely crazy to think that there are investments out there returning 15 to 30%, right? I think it's kind of
Right.
arrogant, honestly, to think that your investment portfolio is the best one out there and to not even consider the fact that someone else is outperforming you, right? And if someone else is outperforming you, how are they outperforming you, right? How much
Mhm.
and what are they doing, right? And for me, I just thought about it. There's no way the wealthy are just sitting there waiting 10% a year. In 50 years, I'll have something to retire and I'll be 75 then. There's no way that they're waiting for that. They're doing something else. And syndications is part of what they're doing. So that's the returns on cash flow. We see anywhere between 5 to 20% cash flow, depending on the deal. Now you might say, hey, you said the stock market's 4%. Now you're saying 5 to 20%. That 5% cash flow, if it's that low, typically the deal has a lot more in appreciation. Again, when we combine our cash flow with how much we gain from appreciation over time, we typically achieve that 15 to 30% return range. Tax benefits, 0.3 tax benefits, and real estate are pretty great. They reduce the taxable income or defer the taxable income you have to pay on your investment. With oil and gas and likely other energy investments as well that we're looking at, and we can dive into this a little more, you not only have the ability to reduce your income or defer your income from your investments, you can actually reduce your W-2 income, taxable income. You can also reduce your taxable capital gains liability too. Fourth, risk. I would say again, real estate is a much safer asset class than the stock market. Oil and gas could be as risky as the stock market, but there's varying levels of it. But I'm saying that overall, you have assets, primarily real estate and private debt, private lending, that are safer than the stock market. And liquidity, I would say, is one place where some people might say private equity suffers because your money has typically has to be locked up for at least 90 days and as long as 10 years. Again, on every opportunity that we present, we let investors know how long to expect to have their capital locked up for, but it's somewhere within that very wide range. And that is, there's no free lunch, so you have to give some in order to get some. So in this case, you're giving up liquidity in exchange for higher returns, but also I think that's a boon if you have the patience to ride out market cycles. It teaches you to be a diligent investor and make decisions very wisely because you know that once you put this $50,000 down, it is really hard to get back. So you're going to do due diligence, you're going to become an expert at analyzing investments. And on the flip side, once you have made your investment, you won't sell just because of, the slightest disturbance in the universe, right? You won't just sell because they dropped interest rates by whatever, 25 basis points. So I think it teaches private equity investors to be very diligent and very patient. Whereas again, stock market investors, because they have the option of buying and selling like monkeys, they will buy and sell like monkeys, and oftentimes you're going to lose out on otherwise great returns.
I was going to say, I would say to those who say, well, past, call it 4 or 5 years in the stock market, we've seen, 20 plus percent returns. I would say to that, that's historically probably not the mean, right? If you look 10 years out, if you look 15 years out, you're going to see a return to the mean, which is around 10 to 12%. So, expect 10, maybe even an 8 to 10 to 12% return on the stock market. If you're looking for a better return, and which is what we look for in our portfolio, a 15 to 30% return is, what our buy box is, right? And looking to double or better your investment over the time horizon.
Yeah, I would say
So,
popular alternatives to private equity investments, like the most popular ones people can think of, is either one, buying just stocks, or two, it's just buying single family homes. And like significantly less popular, three is investing into like a franchise business, right? Like gas station or something like that. And
mhm,
again, we've evaluated all three of these. If any of them were better, we would have gone into that business instead. The only reason we're in private equity, the reason most investors, passive investors, wealthy investors are in private equity is because that's where the outsized risk-adjusted returns are. And to your point, John, that's something we hear a lot because a lot of our investors are in tech. So their portfolios are primarily in tech or in stocks too. That's how they get
right.
paid is with RSUs, restricted stock units. I don't care about your return until, yeah, you could tell me whatever you want, but it doesn't matter until it's hit your bank account. Until you've hit sell and you show to me that those funds are in your Chase account or your Bank of America account or whoever you bank with, it doesn't matter because the next day, as we've seen time and time again, your 30% return in Nvidia or Tesla can easily be brought down to 10% the very next day because of some very jarring news that has investors spooked. It could be DeepSeek. It could be a war that started in another country.
Mhm.
Anything that doesn't seem like it should affect your return in the stock market will affect your return in the stock market. And that's a great thing about private equity. One of the great things, just because a war starts in another country, that doesn't affect the value of our apartment building. But you can very well expect that it will affect how well your stock portfolio performs. So I would say that's another thing. And like you said, historically, and I was doing analysis for this for one of our investors who was evaluating one of our investment opportunities and comparing it to the stock market. They said, hey, equities have been doing 20-25% the last few years.
Yep.
Yes, but if you zoom out and I showed our investor back in 2014, if you bought and you sold today, arguably at the top of one of the best bull markets, greatest bull markets in history, you're still getting an 11% return. That's it.
Yeah.
So do not confuse a return in 1 year for your return over the rest of your lifetime. Just because you did 30% this year in Nvidia and Tesla or Bitcoin doesn't mean I don't know about Bitcoin, Nvidia and Tesla and other tech stocks doesn't mean you're going to do 30% in perpetuity. And actually, the bank, I think it was the Bank of America analyst or someone who coined the term the Magnificent Seven. I think I was reading some news article saying that he thinks that they could be going away here soon, that their era
Yeah.
might be coming to an end. And
Yeah.
all that to say, companies come and go. Back in the day, people thought, Intel was all the rage or that IBM was all the rage, right? Or BlackBerry,
HP. Yeah.
HP.
HP, GE, right? They were all like just solid stocks.
GE, BlackBerry, companies come and go, and like none we've seen have yet to stand the test of time. But private equity opportunities, you are typically buying individual businesses, and we're typically investing in assets that you will need regardless of what the technological or societal environment out there looks like, right? Social environment. Everyone's going to need apartments or homes. Everyone's going to need energy. Everyone is going to need debt. You're always going to need warehouses for your manufacturing. And so those are the kinds of investments that we like to make, the ones that we can understand and point to and be able to explain to our investors, here's why we are profitable. No one listening to this can possibly explain to me why Meta or Amazon is profitable or what kind of growth they expect over the next few years. You can throw numbers out there, and analysts do that all the time. You cannot say, hey, these are the projections that we're making, and here's exactly why. So
No, go ahead. Go ahead. You
I was going to
go.
say it's a lot easier to point to an apartment building and say, hey, there's 100 units in there. Each apartment pays $2,000 in rent every month. And we can assume that half of the revenue is going to go towards expenses. And every year, inflation is going to be 3%. That kind of math any investor can understand. You do not have to read company reports or annual SEC filings to try to project revenues and make your investments. So,
Yeah. So
yeah.
two things. One is I just dropped in into chat a link to our alternative assets brief. It's a 4-page brief. Take a look at it, download it. It's free for you to download. For those that are listening on a podcast, go to clivecap.com/alternative hyphen assets. Of course, at clivecap.com, you'll see a lot of other interesting and educational content. The other thing I would note is that, reading on the news today and hearing the news today, we know that U.S. new home sales fell in January, 10.5% as compared to December. That's due to interest rates as well as the volatility in the market, just uncertainty in the market. And then, interestingly enough, like the gap between the cost to rent a home versus a unit in a multifamily apartment is the largest difference since Zillow. This is coming from Zillow, has been tracking since 2015. So people who need to rent a home definitely continue to need homes. That points to, build to rent is definitely a great opportunity because millennials and others just cannot afford homes because of interest rates, because of the supply or lack of supply in the market. It's just much more difficult to rent homes. So the need for homes has been the biggest. It's jumped in, with the gap between the home rentals and apartment rentals has been the biggest gap since Zillow started measuring in 2015. And that's due primarily to demographics, right?
Is this home rentals and apartment rentals or home ownership? And
Home rentals and apartment
okay,
rentals.
interesting.
It's the
Okay.
biggest gap. And so it's all driven by millennials who are, aging, right? The medium first-time home ownership, now I'm talking about ownership now, is 38 years old. So you have to be, average is 38 years before you actually can afford to own a home. This is coming from NAR in a study in 2024. Zillow separately found that the median age for renters is 42. And so, and millennials are making up 31% of that ownership, the rental market. So definitely people are continuing because of supply dynamics, because of just interest rates. They're renting, whether it's homes or apartments, they're renting. That points to the demand for apartments, the demand for rental homes as well, or townhomes as well. My next question is, well, now that we set the stage, we understand the public markets, we understand we're mostly, well, historically, W-2 employees had been invested in the public markets. We've introduced a private equity as an alternative. How do you balance that portfolio? And does it make sense, or does it matter what stage in your life you're in? If you just graduated from college, you might have a certain mentality. If you are mid-career, you might have a certain goals and certain investment theses. And then if you are ready to retire in the next 1 to 5 years, say, how should you be thinking about balancing the portfolio and then kind of introducing and or supplementing your portfolio with additional private equity investments?
Yeah, I think this comes down to balance. Well, one, obviously, it's personal preference, right? We can't
Right.
speak for all 8 billion people on this planet and how they invest. But generally, I think where you are in life will affect how you invest and how you
Mhm.
optimize for, I would say, appreciation, cash flow, and risk.
And,
And
and tax mitigation, right? Yeah.
well, yeah, maybe all of the above, honestly. Um,
Yeah.
I think early on in your career, you don't have, private equity, syndication investment minimums are typically $50,000. Usually you won't have that saved up for a couple of years. So I think then it makes sense to stay in public markets and build your wealth that way. Once you hit 50,000, I would say build your wealth that way. Also, obviously, you know, depending on your investment philosophy, financial philosophy, establish a emergency fund and things like that. But once you've had the basic needs met and have your safety net, and you have $50,000 earlier on in your career is when you can take bigger bets, then I would definitely prioritize appreciation over cash flow. And typically there's a trade-off between the two. If your investment's very high appreciation, it's very low cash flow. And one very extreme example of this is investing into startups, right? Angel investing, venture capital investing. No cash flow, very high risk. You could completely lose everything, but your return potential for return is also very high. On the other end of the spectrum, so is on the other end of the spectrum is very high cash flow and very low appreciation. And the easiest way to think about that is just if you were to lend money to folks. And in today's environment, you could probably earn a good 10, 12% in interest.
Right.
No upside, but just consistent income. So starting out, it makes more sense to invest into appreciation, invest into opportunities that are going to yield you outsized returns in general. When you account, and that's not just appreciation, that could be a combination of appreciation, cash flow, and tax benefits, right? Whatever's going to give, whatever's going to put the most money back in your pocket. And early, also definitely work on becoming an accredited investor. That definitely helps. And for those of you who don't know, an accredited investor, it's an SEC definition. You can go Google it. It's someone who typically meets one of three requirements. Number one, over the last two tax returns, you have shown a AGI, adjustable gross income, of over $200,000 or more. Or if you're married, you and your spouse, your partner, your AGI is over $300,000 for the last two tax returns. Or number three, your net worth, not including your primary home, but you can include rental homes, etc., but not your primary home, is over $1 million. So, I would focus on building your safety net, whatever that is for you. Make sure you can make investments and not see that money for 5 or 6 years and still be fine. Two, start investing into opportunities that return a lot of cash to you, like to your pocket, through a combination of appreciation, cash flow, and tax savings. And then three, definitely work on becoming an accredited investor and meeting one of those criteria because some investment opportunities are available to accredited investors only. If you want to publicly hear about these opportunities, you have to be accredited. Any investment opportunity that is for non-accredited investors, you won't find out about unless you met someone or know them personally.
Right.
And most people just want to take on accredited investors because it's just much easier to work with accredited investors. They typically can invest more. So I would definitely focus on that. And then as time goes on, and I would focus on just riskier investments in general. Obviously, depending on what your risk profile is and your financial situation, but that's the time of your life to be more risk prone. And then as time goes on, you generally want to shift towards less risky investments and focus on opportunities that are more cash flow. So over time, transition more from opportunities that have appreciation and transition more into cash flowing opportunities. Like especially as you get older. Yeah. 'Cause you don't know how much time you have left, so you don't know if that risky investment or whatever appreciation you're going to live to see that. And then two, as time goes on, you'll typically work less. You want more consistent income coming in to support your lifestyle. So
I like the classification of capital appreciation in investments. So is your, long-term horizon, call it 5 to 6 to 7 years. You can see capital appreciation, a number of multifamily, other type of real estate syndications are structured that way. The next is cash flow. Like they're not necessarily there's no cash flow, but if you need cash flow, we have debt instruments that definitely spin off quite a bit of cash flow. Just know that they do spin off cash flow, and you'll see, the income coming in and on your AGI as well. So that's a double-sided sword, but definitely, it spins off cash flow. And then third is tax mitigation. And maybe we can talk a little bit about that, the tax mitigation part. We have a lot of high earning individuals in our audience. How do they mitigate the taxes that they see from their stock portfolios, not necessarily their IRAs and 401ks, because those are deferred taxes, but certainly their AGI and then any capital gains that they do sell, whether it's short term or long term.
yeah, the one that I is my favorite so far that I have seen work is oil and gas. And I will start this off with a disclaimer that not all oil and gas investment opportunities are created the same. Some are very risky, maybe even fraudulent, and I would definitely stay weary or just far from those. When I first got started, I first learned about oil and gas investing in February of 2022, just a month after I started my company. I learned about it at a conference, and it sounded too good to be true. And depending on who you invest with, it is too good to be true. The oil and gas space is less well understood than even real estate. So that's one, it's less well understood. It's not as mature of a space. Two, the benefits of investing in oil and gas, the tax benefits are almost unparalleled, very difficult to find. The specific opportunity that I invested in, to give you an idea, and I invested in November of 2023. Once I found a group that I trusted, and yes, that did take me 18 months, 19 months, from February of 2022 to November of 2023 before I actually found a group I trusted. And I'm glad I waited rather than just kissing $50,000 or $100,000 goodbye or more. So every 100K invested, I was able to reduce my W-2 taxable income by 80K for 2023. Now, a lot of companies, oil and gas companies, or whatever, handful of them will take advantage of that. The fact that people are looking to offset their taxes, and they'll dangle it in front of you like a carrot, expecting you to bite. And unfortunately, a lot of innocent investors will bite, and they'll never see their money will never see the day of light again. The project will go belly up, it'll go bankrupt, they won't get the money they invested. And another misconception there, again, if you invest 100K and your logic is, hey, I just want to reduce my taxable income, that will save you maybe 30 to 40K on taxes. If the project goes belly up, you still lost 60 to $70,000 on your investment. So your investment just netted you a negative 60 to 70% return. I don't know about you,
Right.
but that's not the kind of returns that I'm looking for.
Right.
So I don't think anyone is, hopefully not. I mean, if you are looking to lose money or whatever, give money away, there's plenty of charities out there that you can donate to, which would probably be a much better cause. So just because something has tax benefits doesn't mean it's a great return. You could take that money and at the very least put it in the stock market, which I absolutely hate, but you can at least put it in the stock market and get a 10%, positive 10% return than a negative 60 or 70% return. So that's just some a disclaimer. The investment that I invested into, how it works is well, before that, again, remember every 100K invested into this opportunity, I was able to reduce my W-2 taxable income by 80K. Typically translates to a tax savings about 30 to 40K back in my pocket. On top of that, in the last 15 months, I've already made about a 50% return or so, 50. And I will, again, another disclaimer, as time goes on, obviously that return decreases because in oil and gas, the revenue comes from selling the oil and gas that you drill, and it's a depleting resource. So over time, you're going to drill and sell less and less of it. But you will typically get your capital back in the first 2 to 3 years. And at that point, you will still get cash flow every month after that. And so anything you get on top of that is just gravy, right? It's basically like setting up an investment where you have no money in, but you're still getting paid whatever it is, 0.5% every month. I would still take that investment all day long because I have no money in the deal. It's free money, essentially. So you will get your capital back in 2 to 3 years, and then the returns decrease. But in the first year, 1 to 2 years, the returns are amazing. The first 6 months of my investment, I got paid 4% a month, like clockwork. After that, since then, it's been decreasing. Now it's about 1.5% every month. You might not think that's enough, but annualized, that's an 18% return. Again, better than the stock market. So all that to get you excited about how it works, which here's how it works now. We have what are called landmen in oil and gas. Similar to realtors in real estate, landmen track the transactions of mineral land. Someone told me there's a Netflix show on it recently, so maybe you could watch that and get a feel for what they do. But basically, they will notice if a big company, let's say Exxon, is coming in to drill for oil and gas in an area, then they let us know. And that matters because if a big company like Exxon knows and is buying land up in an area, that means they know oil and gas exists there. Typically, they will pay geologists, top dollar to confirm that there are deposits of oil and gas in the ground. They don't just go drilling holes willy-nilly anywhere they can find. That's not a good business strategy. Once these big companies know, typically billion-dollar companies, sometimes tens of billions of dollars, publicly traded companies know that there's oil and gas, they start buying land in the area. Once we notice that they're buying land, that means we should go buy land right next to them too. Because as long as you buy land within the vicinity of where the oil and gas is being drilled and extracted, you as a landowner are entitled to a portion of the revenue. You don't have to buy the exact square inch of land where the drill goes into the ground. As long as you buy within the vicinity, you will get that revenue. And that's how we get the cash flow because we are owner of the land. We get the depreciation, like the tax benefits, because we acquire what's called a working interest in the land. And we can probably just do a whole separate oil and gas episode about that. But the risks, and John did just throw a link in the chat about our oil and gas podcast, but we'll include a link to it in the show notes too for those of you who are listening at home.
Episode 49, if you're looking for it on our YouTube link.
There we go. Investing for generational wealth, all major podcasting platforms and YouTube. So, where was I with that? Oh, so with the risks, right? The way we minimize risk of hitting a dry well is and not getting any return is one, we wait until well-established companies going in to buy land. That minimizes risk because if they're buying land, then we can usually piggyback on them doing their research and homework. We copycat them basically. The second, we typically buy multiple wells, so that even if one oil and gas well is there were just balloons that floated by. Okay, I should definitely something in my Zoom is whack. Anyway, if you buy 10 wells, even if one of them is dry, then the other 9 can make up for it, right? So again, just don't put all of your eggs in one well, as the famous saying goes. Put them in multiple wells. Oil and gas wells, of course. Where else do you put eggs? So that's one way we mitigate risk. And then another way we mitigate risk is we buy in certain mineral formations. We only buy in about 4 or 5 in the country, even though there are many more. And then third, just making our financial projections, we just assume very conservative pricing for the price of natural gas and the price of oil. It's obviously a very volatile market. Oil goes up and down very frequently. And so definitely don't put your entire portfolio in it, but I think it's a good component of your portfolio. And then John, I could probably turn it over to you now, because I know you experimented with a pretty interesting tax saving strategy as well, which, for a disclaimer, because we love our disclaimers, you are still waiting to see how it pans out, but it's just,
That's
let's
right.
get gears thinking about different ways they can legally and passively reduce their tax liability.
Yep, there's actually 2 other strategies I had in mind, which is one, we'll talk about this in a little bit after the one I talk about, which is the self-directed IRA. And I'm going to put a link into episode 48, which where we talk to a self-directed IRA expert on that. But the one that I think, Keshav, you were referring to is pretty interesting. It's basically a charitable contribution, but it's an investment into a charitable entity. Traditionally, if you invest in any charitable contribution, say you invest $1,000, give it to Goodwill, Salvation Army, whoever it is, you can deduct $1,000 as one of the itemized deductions on your itemized deduction schedule. That being said, you have to exceed, $30K if you're married, filing jointly, right? You have to exceed that standard deduction. So 1,000 doesn't really do much of a dent unless you have other type of itemized deductions. In this particular instance, there's an entity that, at least one entity that I know of, there are probably multiple entities that provides you a 10x multiplier on your contribution. So you contribute, say, $1,000, you can get a $10,000 write-off on your itemized deduction. Now, again, you have to exceed the 30,000 in order to for this to be effective, and it cannot exceed 50% of your AGI. A lot of tax specifications, but just know that it has to exceed your standard deduction to be effective, right? Otherwise, you can just take your standard deduction. So what I did was contribute 5,000. I am undergoing the process of getting the 50,000 tax write-off on my itemized deduction. And then I have other itemized deductions I can put on that schedule to increase the deduction against my AGI. So that's the great thing about this particular approach. Anyone that's interested, by all means, let us know. We're testing this out, as Keshav said. Like we want to, for everything we do, we want to try it out ourselves first to make sure it's on the up and up and it's effective for our investors as well as for ourselves, before we open it up to everyone else. So just know that we will make this available once we have this is tried and tested. I'll file my taxes this year. Let's see how it goes. I'm crossing my fingers I won't be audited, but it's a $5,000 investment. In many ways, I hate to say it's like gambling because there's IRS tax code behind charitable contributions. The entity that I invested with has done this for a number of years now, so crossing my fingers that this will go through.
Yeah, we should definitely do a whole other episode just about that because I would be
Yes.
interested as well in how they're achieving that 10x leverage.
The other one that Keshav did talk about is self-directed IRAs, which is, if you think about your traditional IRAs, whether they're Roth, they're traditional, even like a solo 401k, other types of 401ks. If you invest through a Fidelity, a Vanguard, they're traditionally making public equities available to you. Maybe even some ETFs, mutual funds, and others. But they typically don't allow you to invest outside of these public markets. Well, a self-directed IRA custodian will allow you to invest outside of these public markets in most anything that you would like to. There are some prohibited transactions, but more often than not, they'll allow you to invest in real estate, which is a top asset that you can invest in. They'll allow you to invest in cryptocurrency, art, like a plethora of different investments. Obviously, we prefer real estate or real estate adjacent type of assets. We do have an episode that is focused on self-directed IRAs, but essentially think of them as any other type of retirement asset and retirement asset portfolio. You don't have to pay taxes until it's withdrawn. And if it's a Roth IRA, even better, because you don't have to pay any capital gains taxes because the monies that you put in is post-tax, right? And the money you withdraw is tax-free. So if it's Roth IRA that you opened up, even better. Any capital appreciation, any capital gains on that, or appreciate on those assets, any dividends, any interest that is spin out of those assets that you invest in, it's all distributed cash-free as you distribute the funds upon retirement.
Yeah,
Yeah.
definitely go check out episode 48.
So definitely an interesting approach to mitigating your taxes. So those three, there are a couple others that we can talk about, but those are the primary ones that we see in market that we often recommend to our investors. So we talked about life stages. We talked about maybe the risks. We talked about mitigating tax burdens for our investors. How do they maximize both the deductions and how should they think about structuring these portfolios in their account? So they typically have a 401k, they typically have an IRA, they might have some disposable income. Where and how should they move some of the funds to be able to invest in real estate? And what's the process typically?
Yeah, great question. So there's three ways to invest into syndications, aka these private equity opportunities. The first one and the simplest one is cash, right? And I don't mean actual green, dollar bills. I mean just wire, right? From your checking account or your savings account, however you have it set up, into the LLC that is buying the asset, right? That's one. And whatever you need to do to get that cash, right? Most people typically they have it sitting there saving, or they have to sell out of the stock market. Those are the ways. And again, you can just initiate that transfer from your bank account, Chase, Bank of America, whoever you bank with. Second is using the self-directed IRA method that John mentioned. Typically, most companies will not allow their current 401k to be transferred into a self-directed IRA. But if you have a 401k from a previous company, Don't roll it over into your current one. You can instead roll it over into a self-directed IRA, keep a lot of the same tax benefits that John was alluding to, and invest into these private equity opportunities. If you have other types of retirement accounts, like a SEP IRA or a Roth IRA or any of those, or like government pension funds, definitely worth looking at how you can, again, roll it over into a self-directed IRA, and our partner, Advanta IRA, they help with that. And just for those listening, my parents, other family members of mine, some of our other investors, and John too, recently, have used their retirement accounts, rolled it over into a self-directed IRA with our partners at Advanta, and invested into our opportunities. Third is using leverage. I definitely wouldn't recommend this until you exhaust the cash that you have or are willing to deploy into private equity and any retirement funds that you're willing to deploy into private equity. But you can take out a loan, right? That's what I mean when I say leverage. You can take out a loan. The easiest one that most people can take out is the HELOC, home equity line of credit. You can take it out against your home. Maybe if your home is worth $1 million for easy math, and then because I don't want people in the comments saying, "Oh my God, oh, so presumptuous to assume," none of that. Maybe it'll give you 60 to 70% of your home's value in loan proceeds. So that's 600 to 700K that you can access. Let's say right now it's probably charging you, again, for easy numbers, 10% interest, or maybe 9%. And John, correct me if I'm wrong. But let's say it's 9 to 10% interest. The loan is charging. You can use that to invest into a syndication opportunity that's giving you 19 to 20% return. Again, just for easy numbers. Then, if your investment's giving you 19 to 20% and your loan is charging you 9 to 10%, you get to profit the 10% that's in between. And these, the home equity line of credit is probably the most popular, but you can take out a loan on any asset. You can take it out against your stock portfolios. I think if you have a really nice car, you could take it out against that, art collections, anything that could be used as collateral, basically. And then I would also recommend that, specifically with the retirement accounts, because they cannot utilize tax benefits of whatever investments you're making. And that's because the self-directed IRA vehicle is already a tax benefit itself. You cannot invest that into another tax benefit. That just isn't how it works. I would recommend using that for investment opportunities where there are no inherent tax benefits. And usually that's best for private debt or private lending opportunities because the interest that you use, you would normally have to pay AGI, you would have to pay income tax on. There's no depreciation, but inside of an IRA, you don't have to pay any taxes. So, and then for a HELOC, for example, any investment where you're taking out a loan to make an investment, I would personally recommend investing those into cash flowing opportunities for the most part,
Right.
because that cash flow will help you service your debt on the loan that you take out. So there's ways to optimize where, you can sleep well at night, but also maximize your earnings, your, tax benefits that you're getting, et cetera, et cetera.
Yeah, and use your common sense. If your HELOC is, call it like 15%, and you're investing in like an investment that spins off 18%, that 3% is probably not worth it, not worth the squeeze, right? So, but if your HELOC is at, let's call it, and if you had your HELOC open a while back, like I did, mine's 3 plus prime, so it's probably at like 7, 8%. I can look at, for example, our mezzanine debt fund, that's like 16 to 18%, 16, 19%, right? And I can take advantage of that spread, right? And that's a great spread to take advantage of. It's, not guaranteed, but it's been returning that percentage over the several years that it's been running. In fact, better in past years. And so that I can use as monthly cash flow. I wish I would have been able to do it out of my self-directed IRA. I did not do that, but in the future I probably will. But like Keshav was saying, do think about, use your common sense when you go about investing. And the other thing about self-directed IRAs is absolutely you cannot utilize the tax deductions, meaning if there's a cost tag, if there's some type of real estate depreciation, you can't leverage that in a tax advantage fund holding account anyways. But that doesn't prevent you from actually investing in those real estate investments in your self-directed IRA. You can still invest in any type of real estate syndication or investment in that account. It just won't be able to leverage the tax deferments or tax depreciation from those accounts. Just know that. What about, we're in an administration, political administration these days that's a little bit tumultuous. It's rocking the stock market up and down. We saw like a 770 point dip a few days ago, right? It's going to rise, it's going to fall, very high volatility. How does that affect private equity versus the traditional public markets?
So I'd say the new administration seems to be very business friendly. And I mean, I obviously politics and everything aside, right? We'll have to see how things play out. But to seem very business friendly, very investor friendly, especially if they will be bringing back 100% bonus depreciation, which would be huge for investors. They're also, very friendly to oil and gas investors, drill baby drill, and just encourage business growth in general. So I think now is a great time to invest. I don't know that there's ever a bad time to invest, right? Like you just
Right.
invest and don't time the market until you're really wealthy. At that point, it might make sense to try to time the market. I think that there will be a lot of opportunity in general. As far as inflation rates, well, that's not something the administration can control. Well, yet we'll see what they do. We don't see that coming down anytime soon, though. So I think our private debt opportunities will continue to do really well. Real estate will continue to do really well. I mean, the caveat there is if regulations are significantly loosened and that just unleashes a whole new wave of supply onto the market. One, because of reduced costs in building new inventory, and two, reduced timeline in building new inventory.
Right.
Then maybe that could hurt a little. But again, that's just 4 years of this administration. The next administration could come in, tighten up regulations, make it very difficult to build housing again, and then you boom. Your housing prices will boom because of appreciation and lack of new supply.
Yeah.
So now let's see. I think manufacturing will do really well too. Tariffs, right? Because of tariffs and this onshoring or reshoring, I think it's called, bringing more businesses back to America. Manufacturing will do really well. And because of manufacturing, industrial real estate, real estate that we invest into, I believe that's a pretty good tailwind for that. So all that to say, I think as an investor, it's going to be a very exciting time. And as, just people who are interested in businesses in general. Very exciting.
Great.
Yeah.
Well, thanks again for the conversation, Keshav. Always a delight to have you back. How can investors find out more about Clive Capital?
I would say it's always, I mean, John says it best, right? Go to clivecap.com, link in the show notes, go to clivecap/alternative-assets to learn about why you should be investing outside the stock market, what are the questions you should be asking when you're investing outside the stock market, and then go subscribe on all the podcasting platforms, whatever you listen to. If you enjoy this episode, leave us a review. If you didn't enjoy this episode, also leave a review just so we know how to get better and hopefully improve the educational content that you're looking for.
Great. Thank you for that. So if you're ready to build that balanced, high return, tax efficient portfolio that we spoke about today, reach out to us to explore passive private equity investments. Don't forget, again, to like and subscribe to our podcasts on whichever platform you're listening to. Make sure that we continue bringing you the best educational content ever. Thanks, everyone. Until next time, keep learning to invest for generational wealth.